Bajaj Twins are the number one, number two volume-led gainers across the board, across the market. The number three name volume-led is NHPC with a 3% pop. And the number four player is Moil with about a 4% gain. I think we mentioned Ajanta Pharma with 11% pop. Mazgaon Dock is up 2% on massive volumes. And Chola Finance, which of course was the standout results and the standout stock yesterday, that's got another 4% on top of yesterday's gain. Stocks 1350 plus now. Look at names like Zensar Tech. Zensar Tech is up 4%, massive volumes. Ugro Capital, I think we mentioned that. Hindustan Zinc is up 3-4%. HBL Power is up about 2.5%. HPL Electric, I think, was up 5 yesterday. It's up another 5 this morning. Atul Limited is up about 3.5%. So there's no dearth of, really large volume-led gains as we start another session. Coforge, of course, there was an attempt at a bit of a recovery. It did see a recovery, and then, of course, it sold off as well. And I think CED is also recovered quite nicely, although it's early days. The low on CED is 2363, and the stock's at about almost 2500, back to about 2500. So there's buying which has come in at lower levels. Samir Arora is with us, founder and fund manager at Helios Capital. Samir, good morning. Great to have you with us here. Thank you very much for your time. It's a pleasure. Samir, as someone who kind of looks at markets from different angles, the global, the local, but maybe the political as well. So I just wanted to start with a third element, which we don't usually talk about, but we're bang in the middle of the election season. What's in your mind with regards to elections? What's the mood like?
So the thing is that the good thing about this round has been that it is not in the mind, because we have sort of taken it for granted that plus minus doesn't matter, a few seats here or there, but that BJP alone will be majority and that the NDA will form the government. If politics was too much in the mind, then that would be a bit scary at this stage, because the assumption for now is that it is a foregone conclusion. So as of now, that is how we are going. So we have actually a second worry, which is that if the government comes in and then the budget is there, on which I've been bullish, I keep saying now via Twitter that I hope the government realizes that they should not mess with capital gains taxes. It will be a big negative and will override every other positive that would have been generated by them.
On elections, Samir, with all
it's time to start lobbying.
No. There's nothing lobbying. There's nothing happening. So let's just go with that.
As a representative of the market, I am saying.
I know. But on the election bit, it's obviously a safe assumption, right? All opinion polls show it. Why should there be any? You can never say no till you get the numbers are in the bank.
No, what I mean is that this idea that there have to be 400 seats for the markets to be happy, I don't think it's required. As long as you have some 280 plus 300 and the overall NDA has 330, 220, I think they'll be equally happy. So therefore, I'm saying from a market, the expectation that we are a little bit in check. And therefore, every day I don't look at politics anymore, because as of now, I'm thinking that at least that much is very easily possible.
I think, this market doesn't need any lobbying, right? Look at the way it's charging ahead. As we speak, the Nifty is at a new high. What has been driving this market? Domestic flows are coming in thick and fast. What is motivating people so much to get it to these levels despite all that is happening globally, Samir? And do you think we can chug along at this same pace?
No, pace, let's say no for now. But globally, the markets have been chugging along very well. So, by the way, in 1 month, the Chinese market has massively beaten the Indian market. And over the year to date, the US market would be, I think, up 6-7%. And our Indian market, if you look at Nifty 500, which would be a fair representation of the market, it's up 9%. So it's not that we are ignoring the world. We are mostly doing in line and a little better. And therefore, it is more sustainable for now. It's not that we are standing out as having done wildly better than other markets. Therefore, it's comfortable.
So if you're saying that the Chinese market has also done so well, is it fair to make that argument that perhaps money would move out of India and into China? Because that's been a narrative that's going on for a while.
I don't think that it draws that. What I meant was that even China is doing well. It's like saying that some beaten up value stock does well, so will everybody move there? Right now, the thing is that China market either as a reaction. Actually, yesterday night, Apple had good results and they said they are not affected badly in China, and China, their issues are exaggerated. And so the Apple stock is up 6.5% after market. Point being that China is doing okay because maybe at this level, it has been beaten up enough, but I don't think it means that some new investor will want that now they should have larger allocation to China than they may have thought 6 months ago. But there will be some guy going here and there because he's already invested in China and therefore wants to play out that before he thinks what to do. But I don't think it's become such a big deal that you will have money going there at the cost of India. I don't think.
All right. Hi, Samir. Good morning. Good to see you in. Samir, you've been a fan of HDFC Bank and you've backed that one up. And as you've been telling us on the show quite often, what about Kotak Mahindra Bank? A spate of bad news coming in there with regard to the RBI action. You have a resignation at the top as well. And, the stock still trades at around 2.3 times odd. Oh, your view on this name from your own?
So actually, we held it for many, many years. By the way, when I was in Alliance, Alliance owned 5% of Kotak Bank, the whole bank that is, in 2001-2. And we held it 3-4 years ago. And then we sold it on the basis, 2-3 years ago, when we saw the issues in HDFC Bank in terms of change of management. And it was visible then and known that in 2 years, which has already happened, that Uday Kotak term will have to end. So we thought the same issues will be faced there, that there will be a follow-on CEO following a high profile and a very successful CEO, and the same issues will come. Therefore, we sold it off. And now I can't talk more on this stock because I have various angles with which I'm associated with Kotak.
By the way, Samir, another thing, right? One of the sort of underlying ironclad assumptions now, which is almost given as a matter of a fact of life, is that retail is the big driver, and it has been the big driver. So that means that any falls which will happen will be shallow, short-lived, and market moves on, and that's been the experience so far. So shocks don't affect us that much because there's a lot of local liquidity, and that is fine. But you had a couple of weeks ago, I think, put out something from, the hedge funds who were trading options in India. And, and talk to us if you think that is a big sort of issue. And any thoughts?
I think that these market-related stocks will, although we also own some of them, but we are just being cute about it, and one day we have to get rid of them, because I think it cannot be the case that the regulator will not put some restrictions, higher margins, higher something fee, higher contract size to discourage retail. This is too blatant. The ratio of how much is the volume of futures and options relative to cash market in US and all, which is considered as a proper developed market, and you see that benchmark, it is, I think, some 20 times that or some such obscene number. It is absolutely wild. And everybody would see that these foreign hedge fund guys, if suppose they have made $1 billion, which means somebody in India has lost $1 billion, there must be some recognition that this is not helping anybody. But you can't do it now in the middle of the election cycle because that will also affect the market. I would think that these market-related stocks, whatever they are called, what are they called?
Capital markets.
Capital market, I think all of them are too much dependent on volume and action in the market. And in the past, the market-related stocks used to trade at half the valuation of the market because in a bad time, they are doubly affected. One is that the valuations go down if the market goes down. But as soon as the market goes down, their earnings fall even more because they are related to the market itself. Whereas for some other stock, say a bank or pharma company or consumer company, you can say the market has fallen, therefore the PE has fallen, but the earnings have not changed because they are not coming out from the market level itself or the market volumes or the market trading itself. So I think this is a bit too much, and it is somewhere around the horizon, but may wait for budget, may wait for election, may wait for something, but it cannot be like this. It is just too volatile.
Okay. So I'm assuming you don't have exposure in that part of the market.
We have. Please remember, I tell you what I feel doesn't mean I have. I am telling you, I am fine-tuning it.
Got it.
I just tell you what I don't play games because I don't care for, telling one something and making 0.5% more. But the reality is it's a bit scary, but I'm also live thinking in front of you, and we have thought about it in our this research meeting, and then decided, we'll do it. But I haven't done anything.
That's a nice one. Live thinking.
One day we'll do it.
So just one thing. So and that's a part which many are very bullish on, and it's a secular kind of a theme because more people will participate in financial markets, equities, etc. What is the best kind of business there? Because you've been in a mutual fund, you've done so sort of across through structures, etc. Is it because now you've got wealth management companies, etc. as well?
Wealth management is a good business.
Okay, you think that is the better one? Because you own the customer, unlike the
and
mutual.
it is sticky. And, sometimes you may go into debt, so you may earn a little less or a little more. Actually, the work done by the poor mutual fund guys is X times more than the wealth manager, but he gets paid only 1/4 of the fee because the rest of it is taken by the distribution stroke wealth management. So I think wealth management is a good business. By the way, we separately are very bullish on the financial services sector in itself. I'm just saying these market-related stocks are a little bit scary. We might even do a mutual fund only focusing on the financial services sometime soon. But I'm just saying, even then, I'm just thinking that because you asked me specifically about this hedge fund and the derivatives trading and the option, I think that is a bit too much. It's too much of gambling.
Okay. I wanted your thoughts. One stock that you guys got bang on is Zomato, right? I mean, as we speak also, it's almost at 200 rupees, so it's a fresh high there. Do you think we are at a stage where this rally that we've seen in some of the new age stocks has reached sort of for maturity, or do you think there's lots more to go?
Well, now you can see our portfolio every month, at least for the mutual fund side. So you broadly will see if you think it's maturity. Right now, we are going with it because the thesis has changed. It was previously a food delivery thing, and we were looking at it. What should be the number of people that you can get, and what will be their average order value and all that. But now it has changed to being a half-an-hour delivery or whatever it's called, Blinkit thing, and therefore it's now SOTP of two different businesses, with the second part growing at very, very high rates. So we stay with it. We are not adding to it, but it has been a good performer. But there have been many others. So when you said, which you got right, I thought maybe you'll ask me about HPCL or something. But anyway, there have been a few good ones discovered in the last 12, 15 months. So it's all good.
Just one final thought on the hospitality, travel, tourism, aviation space, because all of those stocks are moving around, right? I mean, as we speak, Interglobe Aviation is at a fresh high. Would you want to ride on to this theme as well?
So we have ridden on it, but we were a little worried that in summer, the people in India will not be traveling, because it's election time, and therefore people have to stay if they want to vote, or even otherwise. And second, it's too hot to take holidays in India, and even the business guys will not come back for another 2-3 months, maybe, when the foreign tourists might come, or foreign business guys might come back. So I think this quarter won't be good, but we have most of these stocks.
Okay, Samir, thanks a lot for stopping by and filling us in with your quick take on the index, as well as discussing a few stocks. Wishing you a good day ahead and looking forward to chatting up with you rather soon. Well, let's get our next management on the show. KEI Industries, the numbers look pretty okay. Mr. Anil Gupta, the CMD of the company, joins us on the show. Hi, Mr. Gupta. Good morning and good to see you. Well, the past quarter was, showed signs of improvement, particularly on the demand front. And I'm looking at your nearest peer. It appears you grow better than them. Havells is what I'm talking about in terms of revenue growth. Now, you've given us guidance in the past that for FY25, you want to grow by 15 to 16%. Given that the last quarter was quite strong, do you want to up this, or do you want to change it from 15 to 16%? So tell us about that. And on the revenue side, exports will be far better in the coming year in comparison to the past year. So what should the growth look like out there? If you could give us some numbers.
Good morning. Thank you for inviting me to your show. Yeah, as I said in my last interview with you, I think demand is still very strong, and you have seen our numbers in Q4. Overall, in the full financial year, we have grown by 17.3%, which I guided in the beginning of the year, and this year also we expect to grow by 15 to 16% by enhancing the capacities in our existing plants. So far as exports are concerned, we expect to grow substantially. I mean, we have grown in this year by 58%, and I think that we can grow by 50% in this financial year as well, as we have a healthy order book of exports also, and a very healthy inquiry flow also.
Got it. All right.
Yeah.
Got it. Okay. So you've given us the key numbers out there. What about margins? You told us that 11% margins is doable in FY25 and that input cost is all passed through mostly. 11% by which quarter? From Q1 itself, or you're referring it to as an average for FY25?
In the Q4 this year, last year, we have grown by 11%. We have done 11% EBITDA. And overall, I see that we can achieve 11% EBITDA in the whole year. There may be minor deviations from quarter to quarter because of any impact of extra expenditure in a particular quarter. But overall, I can see that I presume that we can do 11% in the whole year.
Mr. Gupta, hi, good morning. Prashant here. Good to speak with you as always. Now, I want to kind of go back to what we spoke about last time, which is input prices, copper prices, etc. Metal prices are at record highs. And I remember last time you were saying you're saying that if say copper goes to say $10,000 in the LME or something, then that could cause some temporary pause in orders. It's a pass-through for you, that we understand, but it is like a one-way move. And I heard some calls for $12,000 of copper, which will then balance the market. I don't know what your thoughts are, Mr. Gupta, here in terms of whether it's going to start to affect demand in any which way.
Prashant, I don't think that it can impact the demand in a longer perspective, because the projects which are undergoing, they will not stop by just because some commodity prices have gone up. And those contracts have limited time period for execution. Otherwise, penalties are, attributed to them. So they have to perform. The pauses are always very temporary, maybe 15 days to 30 days or maybe 45 days in new order booking. But I have seen even in April also, we have seen very healthy order booking, new order booking in April also. And I don't think that it will be a big impact. And always our cost impact is passed through. Whatever material prices or LME prices are going up, we are passing on to the customers in our new offering, new tenders, and also revising our list prices every 15 days or maybe earlier.
Understood. Mr. Gupta, hi, this is Sonia here, and always good speaking to you. So you were telling me about the healthy order book, right? Can you give us some numbers? What is the current order book right now? What is the order visibility that you have over the next 1 year, 12 to 18 months? And what is the kind of order execution that you're looking at? If you can share the numbers with us.
At the moment, our order booking is around 3,500 crore. And but in our type of business, order booking numbers will never be too big because our EPC business is small. For the cable business, we are taking the orders and maximum within 3 to 4 months we are executing it. In retail business, the orders are coming and they are executed maximum within 15 days. So and they are never reflected in the order book. So order book largely relates to B2B orders and EPC orders.
We have this number, 3,531 crores. I'm just trying to understand that what is the incremental order visibility that you would have in FY25, and what is the bidding pipeline looking like? What is the expected conversion? If you can share some details with us.
Bidding pipeline is strong. So far as wire and cable is concerned, EPC, we don't bid too much because we have contained that business within 500 crore. So we have adequate orders to get that revenue in this year. And I think in domestic as well as export market, the bidding to EPC contractors or to the utilities is quite strong. And we expect that we should be able to grow by 15 to 16% in this financial year as well.
Okay, all right. Mr. Gupta, I recall over the last few years when we've been chatting, you have been telling us that the B2C business will gradually move to around 50% of the mix. I think as of now, it's around 46%. So in all probability, in the first half of FY25, you get to that mark. How does this change things? Couple of questions here. What is the margin difference between B2C and B2B? Point number one, if there is one. And also, if you could tell us, how does it impact the working capital days? Please go ahead.
Yes, we expect to reach 50% level in this financial year in B2C business. And so far as margin is concerned, margins are almost similar to B2B because we always, basically it has improved our cash flow cycle. If you have seen our debtor days have gone down by 15 days in this last financial year compared to previous year. And I expect that there is a possibility of going it further down by 7 to 10 days in this financial year. So it is definitely improving our cash flows, and that also always improves the margin.
Oh, got it.
What about a new capacity, Mr. Gupta? I think you'd said that the Silvassa capacity, the cables capacity, will come up in the first week of April. Then I think the Bhiwadi will be commissioned by the end of June. Give us an update.
Yeah, it is on track. Silvassa capacity has already been commissioned and in the commercial production. And Bhiwadi new capacity will be commissioned by end of June. So far as new capex coming up at Sanand near Ahmedabad, that is in full swing in terms of construction. And I expect that first phase should start by April or May next year in the next financial year.
Okay, Mr. Gupta, we leave it at that. Thank you so much for joining us. Always great, learning from you and understanding more about the company. Demand is very strong. Expect growth of 15 to 16% in FY25. When we come back, we'll be joined by Sudhir Singh, the CEO of Coforge, to discuss their Q4 earnings as well as the Cigniti acquisition. Stay tuned.
Okay, welcome back. 120 points higher is what you have. 22,768 is where we stand. Coforge, of course, is the stock of the day, one of the stocks of the day. But, of course, it's down on the downside, 7.5% lower. Weak fourth quarter earnings, margins have contracted, revenues, though, are in line with estimates. The company will also be picking up a 54% stake in Cigniti Technologies. Sudhir Singh is CEO at Coforge. He's joining us now to take some questions. Mr. Singh, good morning. Good to have you with us here. Thank you very much for your time. Prashant this side. Mr. Singh, the thing which many are pointing out, many analysts are pointing out, is the lack of a guidance, sir. You typically put out a full year annual guidance, which you've not done this time around. How should one read that? Is that sort of the lack of clarity in terms of how the business is proceeding, demand uncertainty?
I think one should interpret that as a very strong conviction that the last 7-year growth performance of the firm is going to sustain and very robust growth is going to come in. What we've done this time is we've pointed to the fact that over the last 7 years, we are a firm that has every quarter for 7 years called out our order executable, which is the next 12-month signed order book, every quarter, not just at the beginning of a year. And that's had a very strong correlation with the actual revenue that we deliver. This year, let's start with FY24. We started the year with order executable 20.7% higher YOY, and the firm clocked 13.3% revenue. What we've called out very clearly is we're starting this year with order executable 17.3% higher, and we expect the correlation as it has for the last 7 years to continue. So on the revenue side, we're trying to offer a pointer to a metric that we update every quarter, which we believe is going to be a better surrogate than just an annual guidance. That's point number one. Point number two is we have given a very hard guidance for margins, where we've said that we expect our margins to expand by 50 bips. And point number three, we've again given a very hard guidance around revenue by FY27, where we've said Coforge that closed this year at $1.11 odd billion will be a $2 billion firm at the end of FY27, operating at margins that will be 150 to 250 bips higher than the number that we realized in FY24. So that's how we see the margins, and that's how we see the year that's coming ahead of us, with significant confidence in the fact that growth, and this is organic growth, will be robust.
Yeah. No, I mean, that's great that you're putting out a bigger kind of a vision and numbers for FY27, and we hear that. So then, I mean, it should not be a problem for you to sort of put down a number for 25 constant currency growth as well, right? So at least 13%, we can take that from you for 25?
I can just offer you what I just did, and the maths is, I suspect, fairly simple. 20.7 resulted in a 13.3% growth.
Yes.
We're entering this year with a record Q4. We're entering this year with 17.3% order executable, and we believe growth is going to be robust going forward.
All right. So they're just doing that math itself. You know, when the order executable growth was 20%, you've delivered around 13.5% approximately. If I put in the same matrix, 17% should result in a 10 to 11% growth. Would that be fair?
Broadly fair.
Correct. Yeah, because you know, the number that you're giving us itself is that 0.6, 0.65 in terms of a ratio. So I think 10 to 11% should be fair, and I think you're mostly on board on that. Give us a few more details then. Are you being very aggressive on winning new contracts? Because there is some signs of pricing pressure, right? Give us your take on that.
Why don't I step back for a minute and quickly reflect on the year before I talk about pricing pressures. We've closed the year at 13.3% organic CC growth. And I want to underline it. This is all organic. This is CC growth. We're possibly the only firm that started FY24 with a hard annual guidance, and the only firm that's delivered on that guidance, right? So I think it's important for us to know that. As far as margins are concerned, we were again possibly the only firm that gave 100% salary increments to all its employees on the 1st of April of 2023, something that we will do again this year. So our margin numbers that have come in FY24 came in without trying to effect cost outs at the expense of our employees. And the only change that you see in margin in FY24 over FY23 can straight away be pointed back to the increase in the sales, solutioning, and the pre-sales cost that the firm has increased, which has been parked under the SG&A numbers for our organization. We feel confident about margins. We know exactly where the margins have come in and why, and that's why we've given a very firm guidance for margin for next year as well.
Okay. Sudhir, hi, good morning. I want to talk a little more about the acquisition, right? While it does help you scale up in retail high-tech, the view in the market is that it's not a company with capabilities in this new age tech domain. How would you want to counter that argument?
We would counter it by first reflecting on the fact that we possibly know more about the firm than most analysts in the market would, because we've spent months now working not just through their marketing promotional material, but working with the CEO -1, all the way up to CEO -3. There are three things that Cigniti brings which makes it a game changer, and I say this very consciously, a game changer acquisition for Coforge. Number one, it's not just the two verticals you talked about. 3 new verticals are going to get created. Retail will immediately start operating as a new vertical for Coforge at almost $100 million USD per annum. Healthcare and high-tech that we've talked about for the last 2 years, the merged entity, those verticals are going to be operating at $50 million USD approximately. So number one, 3 new verticals will get formed. Number two, Coforge has been a very East Coast, North America-centric organization in terms of our client presence. Cigniti is a very West, Southwest, and Midwest-focused organization. So number two, our revenues in North America, a geography that we've repeatedly called out as a geography that we want to expand in, will jump day one post-merger by 33% in the sub-areas where we've not been present. Number three, your immediate point around assurance services or testing services. See, all of us recognize, and this is something we've worked over the past few months, AI is going to spread, AI has proliferated, and the expansion of AI is going to mean that the complexity and therefore the opportunity around assurance services will expand in specific areas. Those specific areas are the non-functional testing areas. We work with airlines. We know that every airline that we're working with is looking at possibly an AI engine to help them with revenue optimization. Imagine a scenario where an airline were to put in an AI engine and there was an issue with the algorithm. Functional testing is not going to work in the context of AI-enabled organizations. That's where Cigniti comes in. That's what we've been working with them around, right? Performance testing, security testing, automation testing is where they come in.
Correct. Got that. Qualitatively, I get your point. But quantitatively, can you tell us, I think annual revenues are somewhere around $220 million currently. What will it bring to the table in terms of revenues for your consolidated entity once it comes on board in its entirety? And what kind of sustainable growth rate do you see for Cigniti?
Oh, we see growth at Cigniti at least on par with the organic growth that we see for ourselves. And I've called out very explicitly the fact that our guidance is that our organic growth is going to be robust. And it's going to be in line with the metrics we were talking about earlier. We don't expect Cigniti to be a drag on revenue growth. We think Cigniti so far has the 28-odd Fortune 500 clients where they've fundamentally only been selling assurance services and digital engineering. We are going to go to the same clients, and we will sell the 9 other technology service lines that we have. So we expect Cigniti, at worst, to be growing at the same rate as Coforge, and at best, to be leading it.
All right, Sudhir, a couple of more details then. You briefly mentioned that this acquisition will help you all scale up the US presence. I think North America currently forms around 48% of the mix. Where is it headed from there? Point number one. And also, you're planning a QIP, right? What is the quantum and time frame for it? You've already got the board approval.
First question, 48 is going to move to 55% immediately.
Got it.
Second question, as far as the QIP is concerned, 48 goes to 55.1. Point two, QIP is likely to be of the order of about $250 million. That will allow us to take 51 to 54% stake. Post that, step two is going to be a share swap to complete and to consummate the complete merger.
Okay, got it. So, you told us about the acquisition, right? I think what you're trying to do is with these acquisitions, scale up your US presence, whether it's North America or some other geographies. Now, North America currently forms about 48% of your revenues. With these acquisitions coming on board, how much can you take it up to from that geography?
Day one, as I said, 48 is going to become 55%. And that's a big blip for a firm our size.
Okay, all right. Just to clear this point, 250 million will be raised to get through the first part of it. And is there a share swap as well that you were mentioning?
That's right. We're not going to stop at, you're right, 51 to 54% only. The rest is going to be effected through a share swap. The merger.
And what dilution would that? What dilution would that be?
That would be depending on the market price at that point in time, I guess. That's what's going to determine the swap ratio.
All right, we'll leave it at that. Sudhir, thanks a lot for joining in. Appreciate your time here on CNBC TV18. Well, let's talk about the April auto sales, which were a mixed bag. For the month of April, the two-wheeler sales were very strong. Tractor sales continue to be under pressure. Commercial vehicle sales have seen a bit of a recovery. And in the passenger vehicle sales, it is still moderate growth that we're seeing, especially for some of the larger players like Maruti. Sales growth has been in low single digits. But let's find out what's happening with some of the unlisted players now. Tarun Garg, the CEO of Hyundai Motors India, is joining in. We also have Hemal Thakkar, the director at CRISIL, who tracks the space closely. So, gentlemen, morning to both of you. Tarun, thanks for joining in. This space has overall seen a bit of a moderation in growth, largely because the affordable segment is struggling in the passenger vehicle space, although SUVs are doing phenomenally well. But where are we at currently in the cycle? And what do you see the next couple of months as the big trend?
Thank you, Sonia. Actually, frankly speaking, last 2 years have been so great for the industry. We had an 8% growth last year, and we had a 20% growth before that. So we have had the highest ever, auto industry. So obviously, the base effect is catching up. If you remember, in January end, we had a Siam conclave where all of us put our minds together and try to forecast what kind of growth we can see in 24-25. And we came up with a number which was a low single digit, probably 2 to 3%. And if you see the April number, which is the first month of the financial year, the industry has actually grown by less than 2%. So I think the data, as we all know, reveals as well as hides. So some people would say that the growth has moderated, so it's a cause of worry. But frankly speaking, you have to see the base effect. Number one. Number two, even if you see a 5-year or a 10-year CAGR, we have seen about 4.5 to 5% growth, on a CAGR basis. So I think low single digit is not bad. But yes, because we have been used to this high growth, so maybe we feel that a moderation is setting in. But we have to also look at the fact that the pent-up demand is basically now gone from the system. Because now the semiconductor supplies are normal, the production is in full swing. So obviously, those luxuries of pent-up demand is no more there. So you have to mine every month and sell every month.
So the big trend in the auto space, in the passenger vehicle space, is the growth in SUVs, right? And we've seen some of these listed players like M&M do exceptionally well. Tarun, your own contribution is increasing for Hyundai as well in the industry in terms of the SUV contribution. Do you think the growth has reached a peak, or do you think there's more to go on the upside? And what kind of sustainable growth do you see in SUVs now?
Yeah, so if you see, in fact, we have been maintaining this right from the last 5-6 years that SUVs are the flavor and they are going to be the flavor. If you see Hyundai, calendar year 22, we had, calendar year 23, in fact, we had reached 60% SUV penetration. We had given a guidance that calendar year 24 will be at 65%. I'm happy to report that January to April, we are at 66% SUVs as far as Hyundai is concerned. So we moved from 53 to 60 to now about 65, 66. Even the industry, if you see, has moved to 52 from 48. So I think SUVs are continuously going to grow. And I, for one, don't buy this argument that just because the smaller cars or entry level is not growing, that is having an effect on the overall industry growth. I think the industry growth has been phenomenal, and people are directly moving to SUVs, which is very, very clearly seen that the first timers in SUVs is going up. We have seen this across our venue. And now that Exter has come in, so many first timers are coming in. Going forward, I think there is still more upside. I feel that as against our 60% last year, we'll end this year with 66, 67, and maybe industry could also end up with 53, 54. And that has also to do with so many new models coming in. So I think there is still some upside left as far as SUV contribution is concerned. That said, we have to accept that even if hatches are 25, 26% of the overall market, still we are talking about 1 million volume. So we cannot ignore hatches,
Okay. Hemal Thakkar is also joining in. He's a director at CRISIL. He tracks this sector as well. Hemal, thanks for joining in. Your understanding of the big trends that we've seen in the month of April. We've seen tractors under a lot of pressure. Two-wheelers have done great. Commercial vehicles are coming back. But your thoughts on what the next couple of months could look like?
Thank you for having me. Absolutely right. On passenger vehicles, I completely echo what Tarun is saying. It's been a high base effect, and also the inventory position is very tight. We are still at about 40 days of inventory. That will limit or cap our growth going forward. Completely in sync that we'll see a lower single-digit growth for passenger vehicle industry for the year. So the coming months are not going to be very easy. Moving to tractors, we've seen a very good run in tractors over the last couple of years. We expect this year to see some kind of moderation in growth, considering normal rainfalls to about 3 to 4%. Reservoir levels have also been under some kind of pressure, so rains is going to be a key decider, with respect to tractor sales. Moving to two-wheelers, if you actually see two-wheelers have had a phenomenal run. A couple of reasons. One is low base. Second, one of the largest manufacturers last year had some production issues, especially in the first quarter, and that base has also kicked in. Second, a phenomenal festive season, Chaitra, Navratra, marriage season, etc., has seen very, very good sales, because of which we've seen a very, very strong growth in terms of two-wheelers, not only in terms of wholesale, but also in terms of retail. And stock levels are very, very sound. So from that perspective, two-wheelers could grow at a near double-digit growth for the year. When we then look at commercial vehicles, for that matter, commercial vehicles is a little bit of concern, if you ask me, with some kind of slowdown that we are seeing in terms of construction activities, and hence, kind of some catching up, in terms of heavy commercial vehicle sales. Light commercial vehicle sales have also seen some kind of tapering. What we need to be cognizant of is last year, April also had the effect of BS6 phase 2 coming in, because of which last year, April 23 was a little muted. So low base is something which has helped the CV industry grow. But if you speak to financiers, you will be aware that, they are a little conscious when it comes to funding to commercial vehicles now, as compared to what it was maybe a couple of months ago. So commercial vehicles is going to see some kind of pressure, and we expect the industry to end, on a marginally negative note in the coming year, as compared to, what we have seen in the first month as a start, which is a positive start.
Okay, got that. So that's an overall view on the sector. But Tarun, I wanted your thoughts on the electric vehicle space. Because, so far the EV growth was good, but last couple of months there's been a bit of slowdown. In fact, in the month of April, Tata Motors EV business saw a degrowth, a fall of almost 2%. I want to understand what's happening here. You guys also have, 5 new EV launches that you're planning by 2030. So what's the big trend in EVs now? Are we seeing a slowdown both globally as well as in India?
Look, I think we need to be a little bit more patient, So I think the direction is very clear. We all know that EVs are going to be the future. We have very strong plans as far as Hyundai is concerned. We have already announced a high volume EV in early 25, also 5 EVs by 2030, investing in localization of battery packs. Now Exide collaboration already has been announced in terms of cell manufacturing. So look, these kind of dips will happen, because what happens is whenever such a big transformation or a new technology is coming, the initial set of buyers are the ones who want to take an experiment, who want to be the role models. They are ready to kind of invest even if the ROI is not that good. And after that, the followers look for feedback, an immediate feedback. And then that is where sometimes, because the charging infrastructure is still in the nascent stage, we still have some way to go. So I think this is just a temporary phenomena, which is probably affecting that. That is point number one. I think point number two, which is probably more significant, is if you see the major players in India, the top, 3-4 players, they are still to come big time into EVs, because still, like if I talk about Hyundai, of course we have the Ioniq 5 and we had the Kona, but not in the high volume segment. Some of the other players still to go. So I feel 24 and probably 25, you will see little bit of a muting. But the moment you see more EVs coming from more very established players, I think a trigger will set in, and probably 26, 27, that trigger can happen. And so that we can reach probably around 20% EV penetration by 2030. But we need to be little bit patient. All of us are really working on the ecosystem, and the direction is right, but we should not jump to conclusions just because few months here and there we see some kind of a growth or degrowth. Yeah.
Okay, got that. Tarun, I can't let you go without asking you about the IPO, right? Everyone on the street is talking about it. So just in terms of a timeline, tell me, what are we looking at? Are there reports to be believed that in the month of May or June, we could be staring at a Hyundai India IPO?
Look, I don't want to disappoint you, but sorry, I have to. So no comments, no comments. We have already made a comment from our headquarters. I have nothing further to add on this.
You can at least tell me if it's happening in this calendar year or not, right?
Sorry, I cannot say anything, so no comments for now.
Okay, I'll wait to hear more from you, by the way. I won't leave this topic alone just because you have no comments. But I mean, there's so many rumors doing the rounds. And of course, once the IPO comes through, then it means a lot more opening up of the system for some of the other passenger vehicle makers as well. Well, Hemal, I wanted your thoughts on, the point that Tarun was making about EVs. He said you have to be patient, but, now we are seeing globally as well, right? Tesla scaled down its sales targets. Globally now, hybrids are being preferred as compared to pure play EVs because of A, EVs are so expensive, B, there is this charging infrastructure issue as well. Are you seeing that issue become a hindrance even in the Indian markets? And do you think the EV slowdown perhaps is here to stay for a while?
In the short term, yes, kind of as Tarun mentioned, long-term story is definitely electric vehicles. But what we are seeing is, we are seeing opening of supply. So when I say opening of supply means many new manufacturers coming up with EV launches. So you will have more choice for the customers across the spectrum, right from about 8 odd lakhs all the way to 30 lakhs. And with this new policy of the government of India, which is going to promote manufacturing of electric vehicles of a certain ticket size, wherein you can import at a lower customs duty, will also kind of open doors. So from that perspective, of course, in the near term, we may see some kind of pain because, we are seeing the overall industry itself register a lower growth. And with more options being available and, people developing more confidence on the product with more manufacturers coming in, I'm sure, you will see the industry grow. Our sense is that, by financial year 30, we should see almost 15 to 20% of sales coming from pure electric vehicles or pure BEVs. So maybe in the next 1 or 2 years, we will see a slow growth as compared to what we have seen in the last couple of years, where the industry has grown by anywhere in the range of 50 to 100%. So we may see the growth rate to taper down. However, we still feel, from a long-term perspective, this is the way to grow. And of course, hybrids is something, which will catch up or which are catching up. What is going to be very critical is the price points at which hybrids are going to be available, the delta that you have to petrol price. If the delta comes down, or if we look at, the news that is going around in the market, wherein the government may reduce, kind of GST on hybrid vehicles, if that happens, then we may see hybrids taking a front seat going forward.
Okay. One final question on the rural penetration, because what I've noticed in the last couple of months is that the rural market is picking up X of tractors. So whether you look at Hero MotoCorp, right, it's seen a good growth, of course, on the back of a low base. A couple of other rural plays are also looking good. Tarun, I wanted your thoughts. Is the gap between urban and rural now diminishing? And have you seen a sustainable recovery in the rural market?
I think this is so apt, and I'll give you some shocking numbers, everybody thought that rural was about small cars. Let me give you some data. January to April, my SUV contribution in rural is 67%. My national SUV contribution is 66%. Can you imagine this? This was unfathomable, some years back. I think rural customers are becoming more and more aspirational. The road infrastructure is so good, so they don't mind now buying the SUV. They want new cars. Earlier, they were thinking about, okay, let me buy a used car. Maybe, the roads will not be able to take it, or the service infrastructure was not there. But, this is amazing. Our penetration has gone up to 19.8% rural penetration, which used to be only about 16.5 about 4 years back. And we are seeing increasing demand of the new age SUVs from the rural market. So I think rural is going to be very strong this year. Monsoon prediction is very good. And I have seen that whenever we feel that some kind of a saturation or a low growth is coming in the urban markets, rural always raises their hand up and performs. So we are seeing that. And I believe that rural will really positively surprise not only for Hyundai, but for the overall auto industry as well.
That's actually a very important point you make, that you're seeing a very large contribution of SUVs in the rural market now for you, as opposed to the, conservative thought that only affordable car segment picks up in rural. Hemal, any thoughts on this?
Rural share is definitely increasing. We've seen some kind of pressure till financial year 22, I would say. Post that, we've seen recovery. One major reason is, the price hikes have become relatively muted. Your fuel prices have stabilized for that matter, and that is, something which is giving more confidence. Replacement demand also on the rural side has, started to pick up. And as you rightly mentioned, if you look at the first month itself, with festive season coming in, states like UP, Bihar, MP have outperformed, in showing more than 50 to 55% growth in terms of retail sales based on Vahan data, which also gives you a sense that rural story is coming back in a very, very strong way.
Okay, this was a really insightful chat. Tarun and Hemal, thank you so much for stopping by and talking to us. And Tarun, I'm going to get back to you on that IPO plan. So next time, I'm not going to let you get away.
Okay, thank you, Sonia. Thank you.
Thank you, Tarun. Thank you, Sonia.
Thank you, Hemal, for joining us. Okay, well, that's the word on the auto sector and how it's been performing so far. For the market, not bad, actually. 22,700 is something that's still holding. Mitesh Thakkar is joining in. Mitesh, your thoughts? I think there is better action yet in the mid-cap space today. But any individual stocks that stand out for you?
I think the index, kind of hit the all-time highs and came back from there. I was highlighting this point in the pre-market show. I think that remains a pivot 22,770, 780 zone. And I think we've got a high of 22,795. Broadly, the structure is positive. So anything close to about 22,600, if we get it, not maybe today late evening or tomorrow morning, I think would be a fresh entry point. And for the timing, once we cross 22,770, 780, then I think I look at 23,000 as the next trading target. So maintaining positive bias, but not adding on to index positions. On the stock side, I think, steel names look very good to me. So I have a buy on Steel Authority with a stop below 166 for targets of around 175. And the other one is Tata Steel, which I want to buy above 171. It's made a high of around 170.75. So buy above 171, keep a stop at 167.5, look for targets of 180.
Okay, Mitesh, thanks a lot for that. Well, another day, yet another time, the markets go to around the 22,750 and slip from there. The Sensex is on the verge of moving into the red. The Nifty as well has come off close to around 100 points from the high point of the day, and the Nifty Bank as well. The advanced decline ratio as well should come up for you. Both those two lines were far apart. Now they're getting a little bit closer and getting towards that pretty much even Stevens mark. Both of them are getting much closer to each other. That chart should come up for you on the screen. For the time being, let's shift focus to the commodity markets. Manisha Gupta joins us to tell us, let's do one thing. Let's slip in a short break, come back, and then we'll go to Manisha. She'll tell us what's going on in the commodity markets.
Well, shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, we've been looking at the base metal prices, but I'm looking at ferrous metals right now. And while steel prices continue to see profit taking, we've seen prices decline even below 3,900 there in the Chinese markets. But iron ore prices have been trading on a steady note. So we've rebounded above 117 right now. We did see prices decline to 115. We've done 120 in the previous week as well. But when you look at the overall prices, I mean, this is the range that we saw the last time in the month of March. So strong gains coming back in case of iron ore, at least some stability definitely coming back. The month of April was quite good, 16% of gains into that one, and that was the best month since June 2023. Iron ore prices have started to pick on back of stronger data that we've come in from various international markets, especially China. Just to remind you that China is on a holiday right now and reopens on 6th. So this move that we are seeing is on lower volumes on the Dalian exchange. There is lower guidance also in sense of production from Fortescue Australia. There are various mines which are looking at issues there. And last year as well was lower production there. And this year as well, a repetition of that is something that the street will want to keep an eye on. Having said that, when you look at the Chinese ports, the inventories are right on the higher side. The markets also are getting support from the fact that the China steel exports have gained up by 25% in the month of March. This is year-on-year basis there. China also in the last couple of months has been relaxing home buying restrictions after 13 years of restrictions onto this one. The other sore point really could be that this quarter, which also is about summer and monsoons in China as well, could lead to lower demand from the markets. So you could be looking at some resistance coming in at certain levels here. The imports, pardon me, in China in the last year was at record 1.18 billion. But the markets do believe that this is a target that China perhaps will not be able to do in this year right now. Coming on to prices then, and we've seen an all-time high of 229. This was way back in 2021 in July. And from there, by 2022, we did see a very sharp correction come in for the iron ore prices as well, almost to 85. Now, this is a level that we saw 23 actually start with. But by the time the 23 as a year ended, we were quite on the higher side in sense of iron ore prices, almost to the tune of $145 a ton. As you can see, it was a good gain in the last year, strong gains in what we saw in sense of demand and Chinese buying as well. Now, 145 is where we started this year with, and there was a big correction. We saw the prices fall below $100 as well in the month of April. May has been kinder. We've seen 118, 120 kind of levels, and the markets do believe that while $100 is where you could be looking at as an average for the iron ore prices, the worst case scenario clearly is at 90 on the lower side, and the best case as 125 on the higher side. The street believes that this is the range that the iron ore prices can trade within for all of 2024.
Okay, thanks a lot for that. Let's talk about some stocks on the move now. Ekta is tracking Ajanta Pharma this morning. The stock is up almost 10%. Ekta, over to you.
Well, very good set of numbers. Revenue was up around 20-odd%. The margins expanded to 26%, and the profit was higher by around 66%. And that was on account of a low base as well. But nonetheless, key geographies did well. So India, which is around 31% of sales, was up 14% for the company this quarter. US generics, which is around 23% of sales, was up 32% for them this quarter. Africa institutional was up around 23% on a year-on-year basis. Guidance was stable as well. So low teen growth and 28% EBITDA margins is what they expect. They expect the domestic business to grow around 10 to 11-odd%. They're expecting 6 launches in the US in FY25, 8 to 12 ANDA filings in the US in FY25. And additionally, they have approved a buyback at around 2,770 rupees per share, which equals to around over 250 crores in terms of a total size of the buyback, 285 crores to be precise.
All right, thanks a lot for that. Well, CEAT is the other one we're looking at because the stock is under pressure on the back of weak earnings that the company has posted. In fact, the revenue growth is barely anything. It's in low single digit. A growth of just about 4.1% is what CEAT has clocked in. The EBITDA margins are actually impacted by higher other expenses led by EPR related provisions. Now, EPR is the extended producer's liability, the producer's responsibility, which is a payment that has to be made by the tyre industry as indicated by the Government of India. So that expense is something they incurred on the books, and because of which their margins came in at 13.4% versus 13.1% same time last year. The profits, in fact, for CEAT went down almost 23%. So not looking good over there. Bharat Forge is the other one, by the way. The North American Class 8 truck orders have come in, not looking good. We know this, right, that commercial vehicle industry across the world and in India has been slowing down a bit. So the truck orders have been declining for 5 consecutive months now, and Bharat Forge gets about 10 or 12% of their revenues from that particular market and that sector. So not looking good there. Bharat Forge down in the red. But Sonal is joining in on Max Estates. Sonal, over to you.
Well, you know, Max Estates was higher by 18% yesterday after that fund infusion from New York Life Insurance. Today as well, it is higher in trade because of another development. The company, via its wholly owned subsidiary, has signed a binding agreement for a residential development opportunity. This is in Gurugram, which is their main market. The development will be on 18.23 acres of land with gross development value of over 9,000 crore rupees. Additionally, the company says they are on track to launch their residential community in Q3 of calendar year 2024, which was a new project that they spoke about last year, with a potential of 4,000 crore rupees, which is higher than what they had estimated earlier. So some few triggers that the company has been talking about in this calendar year itself.
Okay, thanks a lot. We'll step into a quick break. On the other side, we talk about companies that will be reporting their Q4 earnings today. There's Titan, there's Britannia, so lots more coming up. Stay tuned. Welcome back to Bazaar Morning Call. Britannia comes out with its numbers today. Mangalam is here to give us the key expectations. Mangalam, over to you.
Well, for Britannia this time around, you know, just like all the other FMCG companies, the demand environment is a little soft, and that's reflecting the stock price as well. It's down about 11% from the highs. You know, valuations are now getting a lot more comfortable for all the FMCG stocks than what they were earlier. So now at around 47 times, largely in line with its average as against a premium. Soft demand environment